So, good morning. Today we're starting a new section of our course. We'll be talking about investment funds and we'll have 3 lessons today, and half of the lesson of Friday will focus on the UCITS directive, and the second part of Friday and the first lesson after Easter we will focus on the AFMD directive. Fund regulation within the EU is actually, today we also have 2 group presentations, the Banco Popular and the Veneto Banca case. So it's only 2 presentations today, so I will speak for half an hour, then leave the floor to the group number 1, Banco Popular. Then I will speak for another half an hour and leave the last 15 minutes to the second group. In order to make the presentations more efficient, I would ask the people of the group to upload their presentation. You can do that straight away. You simply have to avoid sharing the presentation while I speak, but then when you kick in, if you do so, you will have your presentation already uploaded on Blackboard, and you will save and you will save time. Okay, so the first of the 2 directives that regulate investment funds within the EU is the so-called UCITS directive. This is an expression that it's an acronym, UCITS, that stands for undertakings, U, for the collective, C, investment, I, in transferable, T, securities, undertakings for the collective investments in transferable securities. And these are the oldest kind of funds that have been regulated in the EU. As you will see, the directive dates back to 1985, and it is one of the most successful directives ever established in the EU financial regulation framework. By successful, I mean that if you consider what these directives are there for, why they are there, what is their objective, it is to provide the common framework for the integration of European financial markets. And effectively, in the UCITS directive has achieved the result of creating a pan-European, highly integrated market for these funds. It is a huge market. As of today, I think that the last figures I saw tell me that there are more than 7 billion euros of assets under management in UCITS funds, so it's a huge industry, and the European passport works very well in this market, and the European market is truly highly integrated. Also, UCITS funds, because of their particular characteristics that we will discuss in a few minutes, have proven to be good financial products, resilient to financial crises, and they are recognized all across the world as a brand of European origin that identifies a specific financial product with a certain risk profile. So this directive has worked pretty well in performing the typical tasks that you would look at in considering harmonization of European law and integration of European financial markets. Now, the expression investment funds or management funds is a wide expression that encompasses different kinds of schemes. We will see that there are various categories of funds that you find cited in literature, and UCITS only represent a small part of these wider categories, even if the industry is so huge and important, and it is truly a very significant part of European capital markets. And looking at the basic features of what investment funds are, these are schemes, undertakings that can take up different legal forms that have two distinctive characteristics. On the one side, they employ professionals for the management of the funds. And second, these funds are managed on a collective investment basis or on a pooled basis. Now, the first element, if you think about it, it's similar to what we already saw in the context of MiFID. Also in MiFID, we have portfolio management, and this is a service which is provided by a professional entity which is licensed under MiFID. So this is a common feature both of portfolio management that falls under MiFID and of portfolio management that falls in the fund management's legislation within the EU. The second element instead is distinctive of the fund industry vis-a-vis the MiFID industry, because in funds the management is carried on, the management of the portfolio is carried on a collective investment basis. So the assets which are collected, the funds which are collected from the public, are pooled into a single vehicle, into a single structure, which is then managed in the collective interest and for the collective benefit of all the participants to that undertaking or scheme. So, whereby in MiFID we saw that portfolio management is supported by the suitability assessment, by the suitability rule, and thereby the portfolio management is a tailor-made service which suits the needs and the risk profile of an individual client. In the fund management industry, the portfolio is instead managed in the collective interest of all the participants of the fund, regardless of their individual risk profile or their individual characteristics. And what the fund manager does is to pursue the investment strategy and investment policy, which is set out and defined by the fund's regulation. So this is why it is a collective form of portfolio management. An investment fund is collective because there is no space in this area for the individual assessment of each investor's needs and specificities, whereby the portfolio is managed on an aggregated, pooled basis. And all of these expressions work well. You can talk about collective investment, pooled investment, aggregated investment, but this is the distinction between the portfolio management service that we saw in MiFID and the one that falls under the directives on collective investment management. So there are two separate sub-silos of European legislation. This is a subset of the widest silos of capital markets legislation in the European Union, and it is made up of two directives. Sorry if I repeat, but it's important to sort of trace the borderline of what we're looking at right at the beginning. The first directive is the one we are considering first. It's the UCITS directive, and then later on we had the AFM directive of 2001 that we will consider over time. There are different categories of funds that you find cited in literature, depending on what you look at, whether you look at an article of finance, of law, commercial documentation of other sort, and many different ways through which you can categorize funds. These are just the most obvious or common ones. You may be already familiar with some of these notions, but anyway, let's look at them very quickly. One first big distinction is between open-ended and closed-ended funds. Now, just to make it clear from the beginning, UCITS funds are open-ended funds. You can never have a UCITS fund which is a closed-ended fund, just to clarify, closed-ended funds today fall within the scope of the AFM directive that we will consider later on during the course. Now, in an open-ended fund, it's called open-ended because investors can tendentially at any time invest and redeem their investment. So open-ended, it's like an open door. Investors can get in and get out of the fund practically any time. The biggest part of the UCITS open-ended funds you find on the market, so open-ended funds that fall in the UCITS directive, are tendentially open on a daily basis. So every day investors can invest and redeem their shares or units from the fund. I say tendentially because the UCITS directive requires that a UCITS allows investors to redeem their shares at least every 15 days. So that's the minimum requirement for an open-ended fund to be considered as a UCITS fund. So if you have an open-ended fund which, for instance, allows investors to redeem their shares from the fund once a month, this would still be an open-ended fund, but it won't be a UCITS fund. It would therefore fall under the AFM directive of 2011. So you see that UCITS funds are quite specific. They are open-ended funds, but open-ended funds that need to comply with certain requirements of the directive, one of which is the frequency or periodicity of divestments from the fund. It must be at least every 15 days. But I repeat, most of the UCITS funds that we have on the market have daily redemption frequencies. So they have a daily open door every day. Most of them provide daily liquidity. Some of them weekly, and I know just a few cases of 15 days, but most of them are truly highly liquid instruments where investors can get in and get out. And it's also important to remember that the difference between open-ended and closed-ended funds is also based on the fact that in open-ended funds, investors have the right to redeem their investment. This is a right that the law protects and that they can enforce vis-à-vis the management company. And this right would be daily or weekly or every 15 days, depending on the fund's structure and regulation. Closed-end funds, instead, are funds that allow investors to redeem their investment only when the fund is terminated, at the end of the life cycle of the fund. And this life cycle depends naturally on the type of fund you're considering. For instance, real estate funds are a typical case example of closed-ended funds, and this termination date may be very long. It is, for instance, this is left to national legislation to define the maximum duration of a real estate fund, but for instance, in some countries, such as Italy, it can go up to 50 years, so it's quite long. And in a closed-ended fund, the investor must wait the liquidation of the fund before he recovers his investment. This is why it's called closed, because it's so the redemption is not available but only available at the end of the life of the fund. There are variations to this scheme. You may have closed-ended funds that provide intermediate liquidation frameworks, set, for instance, intermediate periods for the redemption, for instance, every 5 years, every 3 years, and so on. But also you have closed-ended funds that allow the manager to liquidate on an anticipated basis the investments and redeem the units before the final term of the fund. But this is only done at the initiative of the management company. So before the time set out in the regulation has expired, which usually coincides with the duration of the fund, investors may get their capital back plus any profits, hopefully, but this can only happen at the initiative of the management company. While in open-ended funds, investors have a right to receive that reimbursement back. Okay, so that's basically the difference between open-ended and closed-ended funds. Now, markets are evolving continuously, and so you find sort of hybrid schemes of funds that, for instance, you find open-ended funds with a frequency which is every 3 months, every 2 months. This would still be open-ended funds because it's a frequency which is predefined in the funds regulation, but they won't be UCITS funds. And you also find closed-ended funds that provide intermediate liquidations every 3 or 5 years, depending on the situation. But the basic conception is that in an open-ended funds, you have a frequency which is predefined, which means that every X the fund would be in a position to reimburse the investments, and in closed-ended funds you have no such frequency, but the refund of the investments is only at the end of the fund cycle. Another important distinction that is currently used is that between listed and unlisted funds. You can have listed funds of an open-ended or of a closed-ended funds, and listing the fund's units on a trading venue, whether it is a regulated market or an MTF, is a good way to provide additional liquidity for investors. And for instance, there is a huge market in Europe for UCITS listed funds that are called Etfs, European Exchange Traded Funds, Exchange Traded Funds, ETFs, Exchange Traded Funds. Now, these are, most of the times, they are UCITS funds that track the index of the stock exchange or another parameter, so they are what you would say passive investment funds. They do not really engage in an active, in a proactive investment strategy, and they are listed on trading platforms. The market is quite huge, and the reason for this is that accessing trading platforms allows to achieve a reduction of the commissions that are involved in the mechanism of underwriting and redeeming the shares of the fund in a traditional model. So investors can buy the shares of the fund on a secondary market without facing the hassle of going through the procedure that typically, and the costs that typically are associated with underwriting the units of the fund in a traditional way. But you also find funds, closed-ended funds, which are listed, and this is a good way to provide liquidity to investors, since, as I said, in closed-ended funds, investors should wait the end of the life cycle of the fund. And if they have a secondary market where they can buy and sell the fund's units, this provides additional liquidity. And there is generally a problem with listing funds, which has been studied quite extensively in literature, especially financial literature. And the problem is that there is tendentially a discount between the price of the shares of the fund on the market and the NAV of the fund. This discount is significant, and sometimes quite significant, for closed-ended funds that get listed. So, and this discount can get very wide. We've had cases of discounts reaching, for instance, 30% of the NAV of the fund. So if the NAV of the fund is 100, the price on the market is 70, which is, we've had cases such as this one. And in other cases, for instance, for ETFs, the discount is virtually null. because markets are more efficient. And this is an interesting phenomenon to study. There are different reasons for this, and basically it reflects market inefficiencies, because in theory the market price should be fairly aligned, if not equivalent, to the NAV of the fund which is listed. Another distinction that you find is between guaranteed or capital protected and versus unguaranteed funds. In guaranteed capital protected funds, you find different mechanisms through which the capital of the investor is guaranteed. It might be that the restitution of the capital is guaranteed. You can even find funds that provide a minimum guarantee in terms of result. These are very expensive products to launch on the market, and they generally imply the support of a third-party entity that provides this guarantee for the benefit of the investors. It might be a credit institution or an insurance company that provides this form of guarantee. And naturally, these products become very popular when you face situations of financial crisis or financial distress on the market, and investors' preferences turn towards more secure forms of investment. So they're willing to pay a higher amount of commissions and costs, but in order to protect their capital. And then looking at European legislation, the big difference that you find is the one between UCITS funds and AIF funds. The acronym AIF stands, as we will see, because we will talk about this directive in details, stands for alternative investment funds. So the expression alternative investment funds in Europe is a very broad expression that encompasses a wide range of products, and all of the products that are not UCITS are called today alternative investment funds. Now, the AFM directive, as you will see, was put in place only in 2011. So it's much more recent than the UCITS directive, which dates back to 1985. And for this reason, for let's say more roughly 30 years, because the AFM directive is 2011, but it was implemented in national legislation around 2014, 2015. So for more than 30 years, the only harmonized legislation on investment funds in Europe was the UCITS directive. And colloquially, this was also identified by saying harmonized funds, and harmonized funds were basically UCITS funds, because for roughly 30 years, that was the only harmonized regulation of investment funds we had across Europe. So you still hear people talking about harmonized funds, and they think they're talking about UCITS funds. But today, also funds that fall under the scope of the AFM directive are in some way harmonized, even though we will see that the AFM directive takes an approach towards harmonization which is profoundly different as vis-a-vis the approach taken by the UCITS directive. There is a huge distinction in terms of approaching harmonization between UCITS and AIF funds. But harmonized funds is still used as a synonym of UCITS fund, even though it is not so to say precise anymore, because after the AFM directive, we do have harmonization also for funds which are alternative and not UCITS. Before we start with the first group presentation, I just want you to show on these two slides the historical evolution of the UCITS framework. As I told you repeatedly, the first directive is 1985. It was a pioneering directive. It was actually, together with the first Prospectus Directive, it was the first directive that made up the core of capital markets legislation in the European Union. So very, very, very innovative and very interesting and very successful as well. The directive was amended the first time in 2001, then 2009. Obviously, you are not required to learn by heart all the references of the directive. You simply have to sort of remember that there has been a historical evolution that led to 5 different versions of the UCITS directive, and the last one dates back to 2000 and 2014. Now, over time, the directive, by being regularly updated, was able to catch up and follow market evolution, and especially the evolution that could be identified in the main marketplaces in Europe for UCITS funds. And without hesitation, you can say that the main marketplace where UCITS funds are located is Luxembourg. It is the widest market for UCITS funds. Most of the biggest European market players in the UCITS industry are based in Luxembourg. And this is because since 1985, Luxembourg was very quick and efficient in transposing the UCITS framework and in setting up a market infrastructure for UCITS funds, which worked pretty well. Custodians, service providers, outsourcers, the small country of Luxembourg, which is just a tiny piece of land if compared to the rest of Europe, has grown up and has become the leading marketplace in Europe for UCITS funds. Not just for UCITS funds, there are other sectors where the Luxembourg marketplace is very attractive for market players, but UCITS funds is really one of the big industries that you find in that tiny country in Luxembourg. And also tax advantages for investment managers, which incorporate in Luxembourg, were a driving force to attract business in Luxembourg in this very important European financial industry. And now we are in the process of discussing a possible revision of UCITS 5, leading to eventually UCITS 6. Here, the consultation is lagging a little bit. Actually, it's 10 years now that this process of reforming UCITS is going on. Some of the topics that you see in this slide have been actually now taken out of the process of revising UCITS and subject to special European legislation. For instance, the idea that you can use UCITS funds, this huge amount of resources, 7 billion euros, it's an incredible big amount of funds being managed by the UCITS industry to support long-term investments in Europe, which was one of the scope of the revision of UCITS 5, as you see on the slide, has now been instead caught up by the AFM directive, and you find specific rules in that context for long-term investment funds. But basically, this is just to explain that the UCITS directive is bound to undergo a constant process of revision and update to keep it in line with market expectation, both on the side of the industry, but also on the side of investors that have confirmed that they are truly interested in these asset classes, as you can understand from the huge amount of resources that are today managed by the UCITS fund management industry. Okay, so I will stop here, and I now leave the floor to the first group on the Banco Popular resolution case. You can upload your presentation or share it if you have already uploaded it, as I suggested at the beginning of my intervention. Thank you.
Okay, Professor, can you hear me well?
Yeah, sure.
Okay, perfect. Okay. So I will share the presentation if it's okay with you.
Good.
Okay. Good morning, everyone. Today we are pleased and excited to present the case of Banco Popular Español, which traces back to 2017 and represents the first case in which the single resolution mechanism was put into place to deal with the financial distress of a bank that was covered by the single supervisory mechanism. Today, our presentation will be structured in 5 main points, starting from an introduction of the characteristics and the business model of BP as before the outbreak of the crisis. Then we move on with a series of events that characterize the crisis, both from the perspective of BP and the follow-up actions taken by the SRB and the ECB. Then we delve deeper into the conditions for which resolution was able to be satisfied and will describe the characteristics of the resolution scheme. So our final consideration focus on describing why this first case was successful, but also the limitations embedded. So BP, as before the outbreak of the crisis, was a bank incorporated in Spain with wholly owned subsidiaries also in the US and in Mexico. It counted more than 10,000 employees distributed across 1,600 branches, and it owned total assets of 147.9 billion. Main services that were provided regarded payment and cash services to monetary and non-monetary financial institutions, and also accepted deposits from both retailers and SMEs. The main activity in which it was involved was lending, especially to SMEs, and it had around 20% of the market share in Spain in this activity. So the crisis originated between 2008 and 2016, in which BP started to report an increasing amount of net profit losses in the real estate portfolio. But actual crisis escalated in February 2017, in which it recorded additional 3.5 billion of losses in the same portfolio and 5.7 billion of extraordinary provisions. Due to this concerning situation, in April the 3rd was required internal audit provision, which unveiled 600 million of unreported and unprovisioned loans. This created fear in the market, and it unveiled the difficult situation of BP. For this reason, it announced no dividend distribution and the possible need for corporate transaction. This in order to restructure the capital position and the financial soundness of the bank. So on the 3rd of May, it reported additional 137 million losses in excess of what the market expected. And this caused significant fear, especially in depositors. For this reason, in the months that I previously described, so February to May, it was a massive deposit outflow of around 9.7 billion, which reflected the main liquidity concerns that depositors had. So on the 12th of May, there was the breach of liquidity coverage ratio, and 1 month later, in June, the bank was not able to solve this position. So it required the access of the emergency liquidity assistance for an amount of 2 billion. And with an almost immediate drainage of this cash provision, it was required an additional 1.6 billion the day after. So in this outlook, the activation of the single resolution mechanism was the result of several steps over time. So the first true recognition of a difficult position of the bank by the SRB was around May, in which the SRB asked the ECB for further information about its financial and liquidity position in order to understand what was the situation the bank was experiencing. For this reason, that the SRB hired independent auditor, Deloitte, in order to delve deeper into the situation and assess a provisional valuation due to the characteristics that was experiencing. So on the 2nd of June, the ECB finally assessed that the bank was not able to meet its liquidity needs for the week to come. So the SRB, concerned with this situation, started to look at the market to see whether there could have been potential acquirers. And when all the 3 conditions for a resolution were deemed to be satisfied on the 6th of June, especially the bank being in the condition of failing or likely to fail. So this started the enaction of the resolution process and the final sale of business to Banco Santander. So now I will pass the floor to my colleague, which will delve deeper into the resolution process.
Fede, non ti sentiamo.
One second. Okay.
Let me see if I...
Can you hear me now?
Yes.
Sì, Fede, perfetto.
Okay, I'm sorry for the inconvenience. As I was saying, now we would like to understand how and when the single resolution mechanism is employed. First of all, we must be dealing with a bank which falls into trouble, meaning that its financial situation is such that she is not likely to pay its obligations as they come due. In this case, each bank already has a specific recovery plan, which is adopted right away, and only if this plan fails, the SRM is taken into consideration. At this moment, the ECB, together with the Single Resolution Board, start to analyze if the conditions to apply the single resolution mechanism are met, according to Article 18 of the Single Resolution Mechanism Regulation and Article 32 of the Bank Recovery and Resolution Directive. The first condition is the determination if the bank is failing or likely to fail, assessed by the ECB. If this is the case, the SRB evaluates the lack of alternative private and supervisory measures and the existence of the public interest condition. If the public interest condition is met, the bank goes into resolution, and otherwise it is wound up following national law. So, were these conditions satisfied in Banco Popular's case? Due to its very bad liquidity position, Banco Popular was declared failing or likely to fail by the ECB with the consultancy of the SRB. As stated by Article 81A, the failing or likely to fail condition is crucial for a bank to go under the resolution process, and this condition is satisfied if there are objective elements which demonstrate that the entity will be unable to pay debts and liabilities as they fall due, according to Article 18 4C. After this first step, the SRB must analyze the absence of alternative measures to save the bank, according to Article 18 1C. In Banco Popular's case, the private sector measures did not lead to a positive outcome that would have led the institution to be able to meet its liabilities. Banco Popular was unable to move enough liquidity, either through market transactions or through central bank operations, to restore its position. Besides, the emergency liquidity assistance was insufficient with regard to the timing of the deterioration of BP's liquidity position. Therefore, no supervisory actions, including early intervention measures, could prevent the failure of the institution. Finally, not even independent exercise of the write-down and conversion powers could prevent the failure of the institution, because its problems were due to the liquidity position rather than a capital shortfall. The last requirement needed to apply the SRM is the existence of the public interest condition. The Article 18.5 of the SRMR states in this regard that the public condition is met only if the intervention of the SRB is crucial to achieve the resolution objective stated in Article 14 SRMR and Article 31 the RRD. In determining whether a resolution action in respect of BP were necessary in the public interest, the SRB has taken into consideration the assessment included in the 2016 resolution plan regarding the credibility of the liquidation of the institution under national insolvency rules. The first condition is to ensure the continuity of critical functions, and given Banco Popular's market share, the scheme adopted aimed at preserving the role of BP in deposit taking, lending to SMEs, and providing payment and cash services. Then, the SRM should avoid significant adverse effects on financial stability by preventing contagion and by maintaining market discipline. The other conditions are the protections of public funds by minimizing reliance on extraordinary public financial support, protection of depositors and investors, covered respectively by Directive 2014/49/EU and Directive 97/90/C, and finally, protection of client funds and client assets. In pursuing these objectives, the Board, the Council, the Commission, and the relevant national authorities should try to minimize resolution costs and avoid destruction of value unless necessary to achieve resolution objectives. I will now leave the floor to Luca.
Okay, Professor, can you hear me? Professor, can you hear me?
Yes, we can hear you, Luca.
Yes. Go
Okay,
ahead.
great. So before we dive deeper into the resolution scheme adopted for Banco Popular, we need to recall the fact that the Single Resolution Board adopts, prepares, and updates each year a resolution plan specific for each bank under its control. The resolution plan prepared for Banco Popular hinged upon the consideration that liquidation under national insolvency law was not credible because it would have posed significant threats to the financial stability of the Spanish system and to the real economy. The resolution plan for BP was based upon the assumption of a capital shortfall of the bank, and so it provided for the application of the bail-in tool to impose losses to shareholders and junior bondholders. But the problem with this plan was the fact that Banco Popular suffered from a liquidity shortfall rather than a capital shortfall, and so this plan was eventually not applied. Now we look into the main techniques that were applied to resolve Banco Popular. The first thing that was done was the application of Article 21, which concerns the conversion and write-down powers of the Single Resolution Board. At the beginning, all share capital instruments for an amount equal to 2.1 billion were written down for 100% of their amount. Subsequently, all additional Tier 1 instruments, which were basically non-cumulative perpetual preferred shares, were converted at par into new shares 1, which were new common equity instruments for an amount equal to 1.35 billion. Finally, all additional Tier 2 instruments were converted at par into new capital elements after having written down to zero all the additional Tier 1 instruments. So we have a new capital instruments, which are the new shares 2, from the conversion of the Tier 2 instruments for an amount equal to 685 million euros. In this process, senior bondholders and account holders were not touched because additional losses were covered by the sale of business 2. Moreover, there was no access to the Single Resolution Fund in this process. And now we move to the main technique used for the resolution, which was the sale of business 2, pursuant to Article 24 of the Resolution Mechanism Regulation or to Article 38 of the Bank Recovery Resolution Directive. The sale of business 2 entailed the transfer of all shares of new shares 2, which were the Tier 2 instruments, to Banco Santander for the symbolic amount of €1, in exchange for the promise and the requirement by the SRB of a capital increase needed to restore the capital position of Banco Santander that was present prior to the acquisition. The sale of business 2 was conducted taking into consideration the main principles of resolution, chief among them the principle of no creditor worse of the liquidation, which states that creditors undergoing a resolution procedure should be treated no worse than they would have been treated under a normal insolvency procedure. And this condition was satisfied because under the provisional valuation run by Deloitte, they found out that the fair value of assets was far lower than the fair value of liabilities, thus symbolizing the fact that creditors and shareholders couldn't expect any distribution whatsoever from the liquidation of the bank under normal insolvency procedure. And now I'll leave the floor to Luca for some final considerations on this case.
Thank you, Luca. And as Luca was mentioning, after the acquisition of Banco Popular shares, Santander put in practice some actions. Firstly, because it was required by the Single Resolution Board, the bank increased its capital by around 7 billion euro. In addition, it had to sell 51% of the non-performing loan portfolio for a value of around 30 billion. Santander also started a Fidelity Action program in favor of all the retail customers who purchased Banco Popular shares and subordinated obligation, so basically all the Tier 2 instruments, between May 26th and June 21st of 2017. This program consisted in an issue of perpetual bonds for around 1 billion euro. And to conclude, the Banco Popular case was the first practical application of the single resolution mechanism, and it showed its strength, but also its limitation. In fact, for what concerned the corporate structure, business model, and size, the resoluted bank, Banco Popular, is not comparable with a globally systemically important institution like UniCredit or Deutsche Bank, for example. And even if it was the third biggest bank in Spain, Banco Popular was not a global bank. In addition, Santander already wanted to acquire a competitor, a fortunate condition very rare to happen regularly during a bank resolution, of course. The general banking conditions were also favorable, and the world banking system were able to limit the shock caused by Banco Popular failure. Also, all the creditors that were used to the bailout mechanism were dissatisfied by the bail-in, of course, because for all the losses they had to bear. Finally, but not less important, the Single Resolution Board was also accused of lack of transparency regarding the whole process, and specifically of not having disclosed the proof on why they decided to activate the mechanism. In few words, to understand if the mechanism really pursues its purpose, we must wait for the resolution of a much bigger bank and during a period of crisis. Thank you very much, and sorry for the inconvenience at the beginning.
Okay, thank you. Good. I think that these presentations on the resolution cases and also the next one are very useful, because resolution is quite mysterious when you look at the regulation and the directive. The first time you read it, it's difficult to understand what you're talking about, and it's difficult to envisage how to put all of those concepts in practice. So when you look at a practical case, however, I think that it becomes much clearer, and this presentation is very useful also for the purpose of preparing the exam, even if it is not part of the questions, obviously, that you will have. But I think it's been very useful. Please always send me the presentation after the discussion by the groups, so that I can store it and keep it if I need to remember which group was the one that presented the case. Okay, so let's go back to our slides, and we were looking at the revision of UCITS in the context of UCITS 6. But now let's focus on the definition of UCITS according to the directive. You see, the definition perfectly fits what I've been telling you. UCITS are undertakings that have the object of collective investment, so the borderline between fund regulation and MiFID, in transferable securities or other liquid financial assets. This is essential because a UCIT fund is an open-ended fund with a tendentially daily or very short frequency of redemption. So it needs to have its portfolio made up of liquid assets. And these assets are managed according to typical portfolio management techniques. So they are managed based on the principle of risk spreading. Now, diversification, risk spreading, you certainly know more on that than I do, are distinctive features of portfolio management techniques that are embedded in the definition of what a UCITS fund is. And the units of these funds are purchased or redeemed directly out of the fund's assets. And the directive clarifies that if you have if you have listed funds when the fund manager carries out repurchase transactions on the trading venue in order to reduce the discount between the price and the NAV, this is considered as equivalent to providing reimbursement out of the fund's assets. And this is precisely what you see happens for some ETFs, where when the fund manager sees that there is a tendency that a spread opens up between price of the market and the NAV, it jumps into the market and carries out repurchase transactions to reduce that possible discount. And this is also done for closed-ended funds, which do not fall in the scope of UCITS, but the technique through which you can eventually reduce the discount is similar. You see that the fund manager repurchases on the market the units in order to reduce the gap between the NAV and the market price. Now, the UCITS directive, as amended, contains truly comprehensive regulations, including technical standards that identify in a very precise way the composition of the portfolio of a UCITS fund. And this includes rules on diversification, limits in portfolio concentration, and also detailed rules on the so-called eligible investments. The expression eligible investments is used by the directive in order to identify what kind of securities, what kind of assets can actually be included within the scope of a UCITS fund. Now, the principle is that, as we saw, but it's important to stress it again, UCITS funds are open-ended funds with a high level of liquidity. They must face redemptions on a daily basis, and in stressful market conditions, these redemptions may have a huge impact in terms of size on the fund. And so the fund must be really ready to liquidate practically the almost entirety of its portfolio to face redemption requests that might come up from the investors. So this clarifies why eligible investments are on the one side very subject to detailed regulations that you find in technical standards, but also they are subject to, they're identified at a broad level in Article 50 of the directive, and you see that they include basically transferable or listed securities that can be easily sold. They include other units of UCITS, because in themselves units of UCITS are, as an underlying, liquid, and they can also include their derivative instruments and OTC derivatives, but basically the UCITS technical standards are very cautious in allowing UCITS funds to use derivatives. They limit the capacity of using derivatives to those that are employed for hedging purposes. And this also means that on an overall basis, the risk profile of a UCITS fund is lower. You should expect it to be lower than that of a hedge fund, for instance, or an alternative fund, even though this assumption is frequently questioned in literature and also by market players, and especially you can have alternative funds which employ investment strategies that ultimately end up by resulting in a level of risk which is lower than that of a typical UCITS fund. So you shouldn't take things for granted, because the approach of the legislation is in this sense, but concretely, if you use any technique for the measurement of the risk of a portfolio, such as VAR, value at risk, or other techniques, you may ultimately find that the level of risk of a UCITS portfolio is higher than the level of risk of an alternative fund which uses a very conservative strategy, which is, for instance, a fund which is entirely decorrelated from market trends. But this is due to the fact that the market is very diversified. But the basic approach is that nonetheless, whether more or less risky, the almost entirety of a UCITS fund portfolio must be made up of liquid or easily or assets that can be easily transformed into liquidity so as to face the redemption requests. And this formula has been very successful. As I told you at the beginning, the market of UCITS funds in Europe is truly staggering in terms of size, and these are products that are distributed all across Europe to retail investors, which is the biggest part of the market for UCITS funds. Now, the structuring a fund for the UCITS directive implies, first of all, that you have two players in place, two institutions that are involved. The first one is the management company, and this is the company that sets up and manages the fund. The methodology that UCITS applies for management companies is pretty close to the one that we saw in the MiFID context and also in the banking context. Management companies get a license, therefore, the methodology is similar to what you have met. Naturally, since this is another directive, it regulates different topics, you find differences when you sort of go in depth and analyze the specific requirements for setting up a management company vis-a-vis an investment firm, let alone a credit institution. But the methodology, the approach of the directive is always the same. You have an entity which gets a license, and here it is the management company that sets up and manages the fund. And since the methodology is similar to the one that you find in other directives, you would find prudential requirements, such as capital requirements. You would find requirements upon which are requested for the members of the management body, for qualified shareholders of the management company, and internal organizational requirements, such as the ones that we met in the MiFID context. And the UCITS and the AFMD have taken up a lot from MiFID in regulating granting of licenses, organizational requirements, and also conduct of business rules. You may remember that when we began with MiFID, I told you MiFID is very important because it over time it has grown in size, it has influenced other areas of European financial markets legislation, and one of the areas where you most clearly see this influence is fund management regulation. As UCITS evolved from UCITS 1 to 2 to 4 to 5, you clearly see that this impact of MiFID standards on regulating funds is increasing, and it's quite interesting to look at. The second entity that is involved in setting up the fund industry is the depository, or you can also call it the custodian. It's equivalent, depository or the custodian. Now, it is essentially practically always a credit institution, even though in UCITS 5 and in AFMD, also investment firms have been allowed to register as custodians for investment funds. But as far as I know, this has not truly kicked off on the market. And the reason for this is that the requirements that the directives impose upon custodians in order to be licensed as custodians are very, very, very comprehensive. And it is difficult for an investment firm to meet those requirements, especially in terms of prudential requirements, minimum of capital, and so on. So the business is still in the hands basically of credit institutions that get a specific license or visa to act as custodians for investment funds. And also, it is a very capital intensive activity, so that over time, the market of custodians for investment funds in Europe has really become highly concentrated. There is just a small number of global players in Europe that provide these services. Some of them are traditionally, France has had a huge culture in building these capabilities as custodians. So two of the biggest players across Europe are BNP Paribas and Société Générale. But it's truly capital intensive, and you can clearly see that over time, smaller custodians that were set up in certain countries, for instance in Italy, have been sold or merged into bigger institutions. What a custodian does in the fund management structure is twofold. First of all, it is a custodian, so it safekeeps the assets of the fund. Now, this is very important because it means that you are physically segregating the funds of the fund, the assets of the fund, from the funds of the management company. So the management company does not have material possession of those funds. They are placed physically under the segregation of another entity, which is the custodian, which is totally independent, must be independent from the management company. And this is a fundamental measure of protection of investors, because if the management company goes crazy, it cannot run away with the fund's assets. These funds are entrusted with another institution, which is a credit institution with very strict and strong requirements, okay? And the second function of a custodian in the fund management industry is that of controlling and supervising what the management company does. So on the one side, it safekeeps and segregates the assets. On the other side, it must control and supervise what the management company does. These controls are aimed at verifying that the management company does not breach the fund rules when it carries out a certain transaction and so on. It does not enter into the merits of the decision. This is the management company's task to decide what to buy, when to buy, what to invest in, but it must do so in compliance with the fund's rules and with the rules of the directive. And this is the second important function of the custodian. And the custodian has a liability, a strict liability under the directive to perform these functions properly. So it would be liable if it sort of loses the assets that it has to safekeep, and it would be liable if it does not control and supervise the management company properly. It's interesting to note that in the investment services regulation, we have nothing of the sort. We do have rules in MiFID that regulate the way through which the assets of the clients have to be kept, but there is no obligation to entrust, there is no obligation upon the investment firm to entrust these assets to a third-party custodian that would then be also in charge of supervising what the investment firm is doing. So the depository or the custodian is truly a distinctive feature of fund management regulation under the UCITS and also now under the AFMD directive. It's very important, and it's a huge important gatekeeper that protects investors in these products. Now, as you see, the definition of UCITS, the one that we saw here, okay, is very broad. It talks about undertakings. What is an undertaking? How is a fund effectively structured in its legal form? Now, the answer to this question is left to national law. The UCITS directive and also the AFMD directive do not really impose a specific form for investment funds, and this is left to national legislation. So, based on tradition, since member states began regulating funds back in the 1970s and inserting in their own legislation rules on investment funds, we've had some prevailing forms coming up. And in the context of UCITS funds, if you look at what we now have in Europe, if you forget the UK, which is not part of Europe anymore, the prevailing forms are two. If you include the UK and Anglo-American systems, you should add a third one, which is the trust structure, which resembles the contractual structure that you see in 7. So in the UK and in the US, the trust is also used as an alternative for setting up investment funds. And the contractual structure is the one that you see now on slide 11. You have a management company that gets the license, and the management company sets up individual funds. It can set up as many funds as it wants. There is no limit. You have management companies that have hundreds of funds, and each of these funds is a separate pool of assets that under national law would be protected in terms of assets and liabilities. By protection, I mean that I can draw, for instance, a vertical line between different funds, just to show that the assets of Fund 1 would be completely separate from the assets of Fund 2, physically deposited in different accounts of the custodian, and creditors of Fund 1 would never be in a position to attack. So if X is a creditor of Fund 1 would be in a position to attack and seize the assets of Fund 1, but it would be barred from seizing the assets of Fund 2. Okay, so this is basically how the principle of segregation works, also from a legal perspective. So the funds are physically segregated because they are entrusted with a custodian, which is independent, but they cannot even be seized by creditors of another fund, and let alone creditors of the management company. In this scheme, as you see, the unit holders, people who invest in the fund, become unit holders of the fund. They are not shareholders of the management company. So they would hold units which represent their investment within the fund. Now, these contractual funds are widespread across Europe. You find national legislation that regulates these issues of liability, segregation. They're widespread. In some countries, they are absolutely the prevailing form of fund that you can find. For instance, in Italy, the contractual fund is absolutely the prevailing form that we use. An alternative is what the UCITS directive calls statutory funds. Now, in this scheme, the investors become shareholders of the management company. So I think that the difference between slide 11 and 12 is pretty straightforward. In a statutory fund structure, the shareholders buy shares of the management company, and these shares are linked to individual sub-funds. These sub-funds are separate, segregated one from the other, exactly as in the contractual structure, but the investor is also a shareholder of the management company. The most widespread use of the management of the statutory fund structure is the one which results in companies with a variable capital, SICAV, Société d'Investissement à Capital Variable, Società di Investimento a Capitale Variabile. Now, this is the prevailing form of funds that you find, for instance, in France and in Luxembourg. They are not contractual. The most of the funds that you find on the market are not contractual funds, but statutory funds. And this is quite significant because if you think that the prevailing part of the fund industry is based in Luxembourg, and in Luxembourg, the prevailing part of the industry is made up of statutory funds, what you end up saying is that the prevailing part of the industry for UCITS funds is made up of statutory funds in the form of SICAV. Now, SICAV have a variable capital because they issue and redeem shares, tendentially on a daily basis, just as in a contractual fund, the management company redeems and issues units of the fund as investors get out and enter the fund on a periodical basis. Okay, so this is the basic distinction that you find, especially for UCITS funds. You have contractual funds and statutory funds. Alternative funds use many other different schemes that we will discuss over time that are not traditionally within the scope of the UCITS directive, including partnerships, including companies with a fixed capital and not with a variable capital, and other forms that are quite interesting to examine. Okay, so I will stop here now, and I will leave the floor to the second group that will always talk about resolution-related issues, but will examine a very interesting case of small Italian banks that were not actually placed under resolution, but under national insolvency law. So I stop my sharing of my screen, and I leave the floor to the group for the next presentation. Okay, good. You can start.
Good morning, Professor, and good morning, everyone. First of all, I hope that you are seeing and hear me well. If not, please let me know. So we are group 3.2, and we're going to talk about the Venetian bank's crisis, namely the collapse of Veneto Banca and Banca Popolare di Vicenza, the reasons that brought to such result, and the consequent SRB decision. After more than 500 years from the first financial crisis in the Veneto area, it really seemed that history repeated itself. So here you can see the agenda of our presentation, and we are going to start giving you some background. So the Venetian bank's fail is an extremely interesting case at the European level, mainly as a corporate governance and a public enforcement failure, and a significant mis-selling case. It should be noted from the start that both Veneto Banca and Banca Popolare di Vicenza were basically twin entities which followed, ultimately, the same unlucky path. So here there are the main steps of our case, and starting from the foundation, both Veneto Banca and Banca Popolare di Vicenza were established in the late 19th century, and for more than 100 years they kept their local dimension. It is starting from the 90s that they started to expand via M&A both in Italy and abroad, and until the end of 2014, the banks were presented by their boards as extremely success stories. They were among the 120 largest banks in Europe, with a book value of assets above the 30 billion threshold to be considered as big institutions. In the 2 years, 2013 and 2014, both banks launched important capital increases in order to strengthen their capital adequacy requirements. However, at the end of 2014, the banks failed the comprehensive assessment referred to 2013, and the ECB started an investigation within the new framework of the SSM. In mid-2015, several bad discoveries came to light, and especially it was clear how the two banks massively have self-financed their own shares during the recent capital increases. As a reaction, the boards decided to lower their share prices, and they had to transform from Banche Popolari to public joint-owned companies and to list on the Italian stock exchange. At the end of 2015, following the SREP results, the ECB asked the two banks to fix their CET1 capital ratios and to rearrange some of their functions, like their internal control ones and the capital planning processes. However, as Davide will talk later on, no viable measures were there. The IPOs were a huge fiasco, thousands of legal proceedings were brought to the banks, and despite some late desperate moves, the two banks did not survive the reputational damage. So at the end, in June 2017, the banks were considered as failing or likely to fail by the supervisor. We are now moved to the reasons behind this huge debacle, and I leave the floor to Lorenzo. Thank you.
Thank you, Riccardo. I hope that everyone can hear me. And so now we know what happened, but what are the factors that led to this huge debacle? Well, first of all, we identified the first factor as corporate governance, and we would like to highlight two main issues here. The first one is domination by a single individual over the board and the management of the two banks. In the case of Banco Popolare di Vicenza, where Zonin that was chairman for 19 years, and Consolin and at Veneto Banca was CEO for more than 17 years. And this is a well-known trend, and it often tends to reduce scrutiny and supervision over the management, leading to a greater tendency in committing frauds, as it happens indeed in this case. Moreover, the cooperative structure of the two banks was built on the rule one person, one vote, and this might give some competitive advantage when the two banks are small and local, but once you get too big, it usually results in the responsibilization of the management, because by increasing the number of shareholders, you also reduce the power of each of them. And so no one has any more incentives to supervise the management effectively. The second red flag we identified is the massive growth strategy adopted by Veneto Banca and Vicenza, with the aim of achieving size and economies of scale. They committed, in our opinion, to an aggressive M&A strategy that ended up harming the profitability of the two banks. Indeed, as we can see from the chart below, we see that the return on equity declined continuously as the bank became bigger in assets. And this also led to an empower building culture that not only incentivized fraudulent behavior, but it also incentivized the attempt of growing out of problems and bad performances. That is increasing the size and the value of assets of the bank instead of tackling these problems, and so in order to hide big problems and profitability. And obviously this led to a vicious cycle and unsustainable cycle. The third issue that we identified was their apparent easy access to capital. That was first of all given by the so-called prestiti baciati. Indeed, essentially, in a comparative structure, if you are a shareholder, you also gain access to credit at favorable terms. And so the two banks sold the loans with also shares embedded in the package to ultimately increase their shareholder base and potential pool of capital. But this obviously was self-financed capital and led to big problems with supervisors. Then there was also Prospectus Ambiguity. In addition, the two banks also controlled the secondary market of their own shares, leading to market manipulation. And finally, the shareholder base of the banks was almost illiterate from a financial point of view. And here we can open a big debate on how the two banks completely disregarded the suitability assessment test of MiFID I, and how the new structure of the test regulated by MiFID II could have impacted the result of the case. But this is not the scope of our case, so we feel that it is important to leave here an open question. And all these happen in conjunction with the most severe economic crisis of our time, and which caused a severe GDP crunch, a spike in unemployment, and as a consequence, NPLs over total gross loans more than tripled. And so this, in my opinion, it was a perfect storm for two already fragile banks. And in 2016, 2017, the Italian and European regulators had to step in. And now I leave the floor to Alessandro and Davide to discuss their decisions.
Thank you. Thank you, Lorenzo and Riccardo, for your introduction to our case. So, as already said, Alessandro and me are going to examine the decision of the Single Resolution Board of whether placing the bank under resolution, so to give them access to a wide range of tools to manage their crisis, or letting them follow the standard Italian liquidation process. So this decision is based on three conditions reported by the Bank Recovery and Resolution Directive and the Single Resolution Mechanism Regulation. You can see the three conditions here in the table. So the first one is that the bank needs to be judged to be failing or likely to fail by an assessment made by the ECB. The second condition is that no alternative measure is there to solve the crisis. And the third condition is that the institution should be considered to be of public interest. So only if all these three conditions are satisfied, Venetian banks could access to the resolution mechanism. So let's start now analyzing the first condition, looking at the failing or likely to fail assessment. Basically, as we already know, the financial of Venetian banks were deteriorating rapidly. The ECB focused on both profitability and capital requirements to assess whether they could actually fail in the near future. Starting from banks' financial reports, we build a graph in this slide that report key income statement metrics as well as Stage 1 capital ratios. These numbers, just to be clear, only refer to Veneto Banca, but it was, as we know, quite the same for Banca Popolare di Vicenza as well. So as you can see, the business was no longer profitable and accumulated billions of losses, and the capital requirements were constantly unfulfilled, so in spite of massive capital injections. So the conclusion was that the ECB judged both banks to be failing in the near future. So the first condition was ultimately met. Let's now move to the second condition, namely no alternative measure could be employed. So in the next two slides, we will present two possible ways to emerge from the crisis. That could have been a new private capital injection or a merger between the banks. Let's start from the first possible alternative. As already said by Riccardo, both banks tried to go public through an IPO to raise fresh equity from institutional investors. But both the IPOs have been a complete failure. In fact, none of the two banks met the minimum share of requirement, share of subscription to go public, that is 25%. With Veneto Banca, you can see in the graph, that only reached 2%, while Banca Popolare di Vicenza did a little bit better, reaching 7%, but still not enough. So Fondo Atlante, that is a fund created under the initiative of the Italian government to intervene in banking crisis, acted as a guarantor and covered the whole capital increases for both the banks. The key concept here is that private investors no longer trusted these two institutions, and therefore no solution to the crisis with private capital could be considered viable. Moving to the next slide, another alternative measure could have been the merger between the two banks. So these two institutions prepared in 2017 a very optimistic business plan that forecasted a return to profitability in a few years, namely in 2020. This could have been possible thanks to a drastic reduction of non-core activities and operating costs, including staff-related costs. So the ECB carefully evaluated the plan, but ultimately decided that this was not a valid alternative to solve the crisis due to timing reason and uncertainty about the reachability of the 2021 figures presented by the banks. So neither new private capital nor a merger were considered viable. Therefore, the second condition was met as well. So I will now leave the floor to Alessandro for the third condition to conclude our analysis. Thank you.
Thank you, Davide. So as mentioned before, the third condition in order to apply resolution is that it has to be in the public interest. And to this respect, it's important to mention that there was already a resolution plan for Veneto Banca in 2016, but it was based on data from 2015. However, ever since then, there were multiple developments. In fact, from a market dynamics perspective, Veneto Banca experienced significant deposit outflows, and these were absorbed by other financial institutions, however. And secondly, the yield on the bonds of Veneto Banca was more and more disconnected with respect to the yield on the rest of the market. So there was a greater disconnection between the bank and the rest of the financial system. Secondly, from a quantitative evidence standpoint, total assets decreased by 22%, the market share declined to less than 1%, and the commercial funding fell by 40%. The consequences of all this were three. First of all, Veneto Banca did not meet the size criterion in order to be considered a significant institution. In fact, it had total assets for less than 28 billion, whereas the threshold was 30 billion. From a systemic importance standpoint, instead, it was no longer classified systemically important by Banca d'Italia based on the other systemically important institution score. And they also considered the event of a simultaneous failure of both Veneto Banca and Banca Popolare di Vicenza, but they ended up to the same conclusion. And finally, in terms of interconnection, there wasn't financial and operational interconnection significant enough to lead to a contagion risk. However, they also recognized that there was a potential adverse effect on the regional areas where the bank was strongest, particularly in Veneto and in Puglia. So the systemic relevance of Veneto Banca had declined significantly during this period, and the third condition for resolution was no longer satisfied. So resolution was no longer applicable. However, before going to the final decision, it's important to mention 4 other key areas which were evaluated by the ECB. The first one is ensuring the continuity of the critical functions performed by the bank. Veneto Banca performed mainly 3 activities: deposit taking, lending, and payment and cash services. Across all these 3 activities, the bank had lost significant market share, and all the outflows from Veneto Banca were absorbed by the rest of the market, by the other financial institutions. So basically, these functions were substitutable. Secondly, it was important to protect depositors and investors. However, both under resolution and under CAL, they would have been protected. Indeed, under CAL, there were 2 methods for protection. The first one was the transfer of assets and liabilities to another financial institutions, whereas the second one was for depositor and investors, respectively, the Depositor Guarantee Scheme Directive and the Investor Compensation Scheme Directives. Thirdly, in terms of protecting client funds and client assets, this was not a problem. Indeed, under the Italian financial law, there is a complete separation between the creditors and the clients of a financial institution funds. And finally, there was also the goal, of course, of protecting public funds, which was considered. So coming to the conclusion, we ended up in a situation where the first 2 conditions to apply resolution were met, but the third one was not. As a result, on June 23, 2017, the Single Resolution Board communicated to Banca d'Italia its decision to put Veneto Banca under compulsory administrative liquidation, or CAL. And in the end, the performing parts of both Veneto Banca and Banco Popolare di Vicenza were acquired by Intesa for €1 each. And thank you very much. This was our presentation. I hope it was insightful.
Yeah, thank you. Very insightful. Naturally, these 2 cases stirred a paramount of discussions and controversies and polemics, because we are now in a situation where we ask ourselves, when will resolution effectively be applied? Because the public interest test was pretty much debated in the context of Veneto Banca. The SRB said that ultimately these 2 banks are too small, they're local, and they would not have a major impact on the Italian market, because they were below the threshold, I think, of 1%, 1.5% of the entire Italian banking market. But locally, they were predominant. And so some say that this was a way with which the SRB wiped its hands of the problem of these banks, and the others say that this was a way through which national authorities took the problems out of the hands of the SRB and kept it under national insolvency legislation. So it's a major case, conceptually especially, because it sort of proves that the borderline of resolution is not always so clear. It leaves probably a lot of space for interpretation. Okay, so thank you very much and have a good week. See you on Friday. Cheers.
Thank you.
Bye. Thank you.
Thank you. Bye.